Drop. Let's invite our market master for the morning, Tushar Pradhan, the CIO of HSBC Global Asset Management, joins us now. Tushar, good morning. A couple of global events to watch out for. Janet Yellen's statements yesterday seems to indicate that she's satisfied with the economic recovery so far. Would you pencil in a rate hike on December 15? And what does it really mean for India stockholders?
Yeah, I think it is more or less a consensus view now. And I think the statements so far from the US Federal Reserve seem to indicate that they're in line for a rate hike. I think they've promised this for the entire year. We've been waiting with the kind of policy flip-flop that we've seen for a while. But I think with the kind of statements coming through, not only from Governor Yellen, but all of the other governors on the board of the Federal Reserve as well, I think it appears that more or less the rate hike is here, and it might well be that they might actually announce it in December. What does that mean for India? I think that's a million-dollar question or a billion-dollar question, whichever way you look at it. I think the natural impact of a rate hike in the US would obviously mean a stronger dollar, and that means weaker currencies across the emerging markets. Typically, this also means that the cost of money becomes a little dearer, in this sense that from near zero rates, we are going to maybe 25 basis up from there. That doesn't actually mean much from an absolute sense, but from a sentimental perspective, I think what it is signaling is that the era of absolutely free money is over, and the carry costs could now climb a little higher in terms of whatever was possible from previous times. So I think the direction is more important. I think the quantum, whether, and the more important question is not whether she makes this increase now, but what is the rate of increase in the interest rates in the US in 2016? And I think that's the bigger question now to answer.
Okay, so the era of free money is over for equities. That's an important point. Tushar, hi, good morning, and thanks for joining us. I was just going through some of your funds, and reviewing the performance of your funds. One of the most aggressive performances have come in from your mid-cap equity fund, which has given a return of 48% in the last 2 years. And if you take 3 years, then it's given you about 25% or so. And you've had some great performers in this fund, names like Aurobindo Pharma, Cholamandalam, etc. My question is, do you still see a lot more value in the mid-cap space? And if yes, what are the pockets, sectors that you would be bullish on in mid-caps?
I think mid-caps has been a space which has been a bright spot for our economy in the last 2 years. And thanks to our fund managers, I think they've done exceedingly well trying to choose the right kinds. People tend to think of mid-caps as a generic class, but I think there is a lot of quality out there. You have to remember that India still is a very, very developing nation. And most of the businesses which we classify typically under mid-cap are the early stage large caps. So in a sense that if you find a company which has tremendous scale possibilities, a very sound management at the top, and pretty significant market growth potential given the demographics of our country, I think then you really have come up with a winner. On top of that, if some of these mid-caps establish some sort of competitive advantage, or in a more typical norm as is described as a moat, then you have pretty secure growth coming for significant periods of time from here on. The issue, of course, with mid-caps is that they come with a lot of volatility. Some of these companies are unable to sustain longer periods of difficult economic times, and that's the risk that these companies carry. So it's not a given that mid-caps will actually outperform in every cycle. And we've had pretty difficult times prior to the 2 years that you mentioned in terms of our choices of mid-caps as well. So I think it's not a very even game from here on, but we do feel that there are certain pockets defined with the parameters I just described, that if companies display significant competitive advantage, have the scope to scale up without increased requirement of borrowed capital, I think these are the companies which are winners in the long run. And I think India is poised for an economic growth upcycle, and all of these companies within that really display all those perspectives of pretty significant and sustained growth from here.
Okay. Tushar, most of your funds have a lot of investments in the private sector banks. I notice Axis, HDFC Bank, ICICI Bank and Yes Bank figuring in practically all your funds. Will you add more to this, or will you diversify into NBFCs or to public sector banks at all?
See, the banking space, especially the banking and financial space together, has been a very challenging one for the last 2-3 years, for all the reasons that we know, that the economy is going through a down cycle, which means that the assets which the banks have are under pressure for various reasons, that they are unable either to start their projects or to have significant cash flows to support their operations. And most of the larger exposures, of course, are in the public sector banks. On the private sector, what we have are two things. One is their ability to go into the market to raise fresh capital without any issue. If you look at the capital requirement, let's step back a bit and say, okay, if I want to see that the banking sector is going to grow from here because the economy is going to grow, who has the potential to raise capital to be able to feed this kind of growth? So clearly, I think from a public sector banking perspective, there are significant challenges in terms of how much the government can put in the extra capital for this growth, and what is the potential for these banks to go on their own to the stock markets to raise the capital which is required. As opposed to that, with a much better quality book that most of these private banks have, they have much more potential to raise capital in the coming growth period, and they will probably increase their market share going forward. So I think that's one of the reasons why we prefer them. From an NBFC perspective also, I think this is where a lot of financial disintermediation is happening. They can reach a lot many more markets that the organized, much more larger banks are unable to, especially when it comes to either small asset finance or even personal finance to that matter. And probably they know their clients a lot better than what a typical nationalized bank will be able to do. So I think in that sense, there is opportunity across the board. We do have also a lot of disruption by way of the microfinance players in the field. So I think it is a pretty interesting place to be in, but one needs to be very careful about how the eventual economy progresses and how each of these players will take advantage. As I said, I mean, our portfolio positioning represents the attractiveness relative to other markets or other sectors for that period. This is not really a definitive statement, but as we go along, we will continue to see opportunities, and that portfolio positioning may change as we go along.
Okay, I keep coming back to the performance of your mid-cap equity fund because, in the last couple of months, it's been all about mid-caps. And you have a very interesting bunch of sectors that you have in your top holdings. So you have exposure to textile in the form of Wellspun India. You have exposure to leather in the form of Mirza International, and exposure to coffee as well in the form of CCL products. For an average investor, are these sectors still fraught with risk, or do you still expect some of these stocks that you hold to perform well in the quarters to come?
Yeah, I think that's a very interesting question, and I will veer away from the actual portfolio composition. But I would like to say, what is the theme? What is it that investors should see in India? If you look at the three components that you mentioned, they all relate to pretty significant discretionary spends that the Indian population is likely to make in the future. So as we have seen in China, where there is a huge market for luxury goods, where a large mass of people, and we are talking about millions of people, who actually go and buy these very high-priced products, is a function of increasing net income for a large mass of people in China. We are expecting that in India, as the economy progresses, and of course the 7th Pay Commission is one of the other catalysts in this area, we do see urban income starting to inch up. We do see a pretty large potential for high-quality spending to come through, which is actually a little negative from a larger mass in terms of the rural area spending that we have seen for the last few years. But I think urban consumption is clearly the space to be. And we see pretty large opportunities in this area across consumer discretionary, to a certain extent even in cars, passenger cars, stuff like that. So I think this is something which one should look at. As I said, these are the prospects that we look at the moment. And they look pretty solid for us for at least the next 2 years.
Okay, that explains the textiles, leather, and the coffee exposure. One final question then. You have some interesting mid-cap pharma names as well as your top holdings. Names like Aurobindo Pharma, Glenmark. Well, not exactly mid-cap, but non-index large caps. Would you still see value in the non-index names? Or now do you think some of the index stocks, Sun Pharma, Dr. Reddy's, have also become, offer good value?
I think pharma as a sector in India is pretty interesting. A lot of these companies are exposed to the Western markets, especially the US, and the inspection reports that we've seen in the last few months have not been very encouraging in terms of the outcomes that has meant really pretty significant negatives for the companies in question. But the fact remains that the world, including the developed world, is looking to reduce health costs. India represents one of the largest opportunities to feed that increasing demand for lower therapy costs, and by way of very significant approvals in generics can really provide the alternative that the West is looking for. So that's a broad theme. But within that also, I think there is not only the developed market, there are emerging markets as well which are now open for penetration in terms of allopathic medicines across and the usage itself. So while India continues to be a very robust market for allopathic medicine penetration, we think that the Indian space, the Indian pharmaceutical companies, have a pretty good handle in terms of what the opportunity might look and how well prepared they are to actually exploit it. So we remain pretty positive in terms of how the Indian companies so far have actually managed to take care of, or let's say take advantage of this opportunity. But as again I said, these things do keep changing from time to time. What a sun was 15 years ago, maybe some of these newer, smaller generic or let's say even pharma companies could potentially be in the next 10, 12 years. The key, of course, is to know which one to choose. But I think if you are pretty, I would say, resolute about it, have a choice of companies across the board, not really, bet the bank on any one or two stocks, but try to take a portfolio approach in this space. I think the macro is very much in favor of pretty significant returns. Valuations continue to remain a problem because it's not that I've discovered this new. It seems the market also senses the opportunity, but we really don't know what the winners will be in the interim.
All right, Tushar, we'll leave it at that. Thanks for joining us. Well, that's the word coming in from HSBC. We've run out of time. With that, it's a wrap.